So let's get started. Yesterday we were talking about how to make profit in both long and short selling. What is the difference between a long position? You say take a long position in an asset and taking a short selling position. What is the difference between taking the long position and taking a short position? You can buy in both position. There's buy in both position. There's buy in long, there's buy in short selling. Long position, you're speculating that an asset will rise. That's part of the activities. Then you buy now. You wait for the asset to rise, just as you have speculated. When it rises to a target, you sell. But if it doesn't rise, if it falls, you sell also, but in loss. The first one, you sell in profit and you make your profit. While a short sell, you speculate an asset is going to fall. You get a loan of the asset or you borrow the assets, you sell it at the current price, at the prevailing price. You wait for the asset to fall in price, and then you buy it back in profit. The difference of the entry price where you sell and the exit price where you buy back is your profit. But if price doesn't fall down, if it goes up, you buy back as well the assets, you buy the asset back, but then in a loss. So that's the difference between long and short sell. So let's go to some little terminology, some little words that you would be hearing in trading. So let's look at the term currency pair. So currencies are traded in pair. It is the only asset that two types of assets are paired together, which is currency versus currency. The rest of them is stock. Gold is measured in dollar. The rest are measured in dollar, 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 dollar. All of them are measured in dollars. But currencies are paired against each other. So, and this is how it is. So it's not difficult. A lot of you have been, physically going to change one currency to the other, and unknowingly to you, you've been participating in this exchange. So, let's take, for example, a pair of currencies written as euro slash or versus USD. Now, when you see a pair of currency, the first item on the pair, the first item is the one to your left. Whatever currency that is there is what they call the base currency. Another word that can make you understand it is that is the asset in this pair, the real asset kind of you're trading in this pair. The base currency is the first currency to your left in the pair. The first currency in the pair is called the base currency, which is synonymous to the asset that is being traded in the pair. So the first currency on the pair is called what? The base currency. And what does that mean? It means that is the asset that you are trading. The second currency, they call it payable currency. Payable, to pay for the asset, or they call it quote currency sometimes. Quote currency or payable currency. Quote currency means that is the price you will see written against that pair is quoted with that quote currency. So take for example something like this. Imagine you're watching CNN or Bloomberg, all those news channels, and then they popped up something like this: euro slash USD 1.32450. Or you go to a broker's platform and you saw euro versus USD 1.3250. What this statement means is that the asset on this pair is your base currency. You said that is the asset that is being traded in a way. So it means that one of that assets is worth 1.32450 of the payable currency or of the quote currency. So if you are going to interpret this now, you say 1 euro is equivalent or is equals to 1.32450 USD. So the pair is the quote, the value you're seeing there is a quote. That quote is showing in the payable currency. So that's what it means by quote currency. The unit of measurement. So 1 euro equals to 1.32450. Some people have asked the question, say, what if you see USD versus USD slash, what if you see it like this? Some interestingly, I don't think any broker is going to write that anyway, but interestingly, you might see it somewhere. People will write, instead of writing euro slash USD, they'll write USD slash euro. You hardly see this, but if you see this, it's actually not the correct way to write it. This is the conventional way to write it. It's just a globally accepted standard. It has nothing to do with the value of any of the currencies. It has nothing to do with the value of any of the currencies. It doesn't mean euro is stronger than USD. It doesn't mean USD is lesser than euro. It's just a conventionally accepted way of writing these two pair of currencies. It doesn't mean anything. So that they all speak the same language. That's why they all agree to write it like that. You will not see it like this often, but you see it like this more. So euro versus dollar. And that means that 1 euro, whatever it is, the rate equals to whatever the rate is, this maybe 1.222 USD. So it means that if I want to buy 1 euro, I will spend 1.222 USD to buy 1 euro. And if I sell 1 euro, they will pay me, or I will get 1.22222 US. It's just the value, the rate, the exchange rate. We have different types of currency pairs. We have different types. We have the majors. They call it majors because this is the reason why they call them majors. Not today now. Some of you are thinking maybe why they call them major currency pairs because it has US dollar there. No. It's not because it has US dollars. This is the reason why people call it major currency pairs. Number one, it is the most traded pair. They are the most traded pairs, most exchanged between each other. What two currencies are the most exchanged currencies to each other in the world? The most exchanged to each other. Euro USD. Euro USD, exactly. USD Euro, yes. So major pairs are most traded pairs. And the number one most traded currency pair in the world is euro and dollar. Of course, it's not surprising. Dollar is like the most used currency in the world. Then euro is used by 16 nations. So you can, and they are powerful nations as well. So you can imagine these two currencies, of course. So euro versus dollar is the most, followed by others too. That's the reason why they call them major pairs. Another reason they call them major pairs is because they are available. The first one is most traded. They are usually the most exchanged. People come to exchange euro to dollar, dollar to euro. The funny thing is that if you go to Tanzania today and you go and eat in a restaurant and you say, I have Kenyan shillings to pay you, they will not even listen. They will tell you they will chase you out of their restaurant. This is the neighboring country, right? So availability. But if you pay them in dollar, if you say, I don't have any currency with me, I don't even have Tanzanian currency with me, but I have dollars with me or euros, they will say, oh, bring it, because we can always change it. So these currencies are highly available. That's what they call liquidity. So number one, the reason they call them major pairs, they are mostly traded with each other and they are available. They call liquidity. Okay, you see why I told you about cryptocurrency the other day. Cryptocurrency doesn't fall into these kind of things. And some of the assets that you are looking at, volatility index, this, that, all those things, they don't fall into this. Why do we focus on major pairs? So we can have fair prices. Another reason why they call them major pairs is because they are stable. Stable means that if at all they will move against each other, if at all the exchange rate will move, it moves very slowly. You hardly find, they said you hardly find a day where the major pairs move by 2% of their yesterday's price. You hardly find a day where they move by 2% of their yesterday's price. You see why dollar and naira can never be a major pair. You see why cryptocurrency can never be a major pair, a major asset. You see why the dollar and naira, sorry, I'm in Nigeria, so I can talk about it. Dollar and naira is like they actually use their hand to write the exchange rates. They wake up today and say, let us put it at 522. Tomorrow, let us put it at. I really do not know what moves that currency. So these are not major pairs. Any asset that is not major at this stage of your learning, of your trading, stay away from it. Write that down. Any asset class that is not a major. Major means that it is mostly traded. That's why I gave you the assignment to look for the most capitalized assets across all of the asset classes. Now, apart from capitalization, you will also look at the activity, the trading activity of these assets. How often are they being exchanged? How often are they being traded? That is mostly traded. You also look at the availability. Are they easily accessible? Are they going to start telling me stories when, if I want to sell my asset? I remember one back then in Nigeria. Sorry, I'm using Nigeria, of course, that's where I grew up. I remember when I was in Nigeria, some guys would just come up. They would say they are selling a particular cryptocurrency. I think they still do it now. Some people still do it. They will design a cryptocurrency. They call it whatever they call it. Coco coin, John coin, Conrad coin. And then they'll start selling it. I don't even know how to start explaining to them because they don't come for they don't come for the kind of class that you are coming for today like this. I would have been taking time to explain to them. But the question, you know better now. The major problem with that kind of coins is that number two, availability. That's the number two reason why. If I design a coin today and say it's called Conrad coin and say you should come and buy, it's going to go up like Bitcoin. The problem is, who will buy this coin back from my hand if I don't need this coin again? When you go for such seminars, just ask them that simple question. So say, okay, a new coin in town, glorious coin, messy coin, fine. I'm going to buy the coin. It's appreciating, blah, blah, blah. But the question I have for you, sir, if I buy so quantity of this coin now, and I come tomorrow and say, I don't need this coin again, will I see someone to buy this coin from me? If they start grumbling, if they start saying, we have a platform where you go and sell, we go and put it there, people that want to buy will buy, please stay away. I'm sorry to hurt anybody's feeling if maybe you are part of the creator of such coins. This is the only problem that such coins and such assets have. Lack of liquidity. Most traded pairs too is another problem. Stability. If the asset you are trading, that's the problem I have with Bitcoin and the rest of them. If the asset you are trading can jump at will from March, I think it was March. I think it was February to March, within 1 month or 2 months. Bitcoin fell from almost 60, almost 45,000 or something to about 30,000. This is a fall of almost 50%. And it's not like once in a while. It's not like once in a while. This has been his usual. It happened like that 3 years ago. This does not qualify for stability. It doesn't mean Bitcoin doesn't make profit. Don't get me wrong. I'm just advising you that go for more stable assets, highly liquid assets, and mostly traded assets. That is why if that asset, whatever they call the name, binary option, volatility, whatever. If that thing doesn't qualify into these three, doesn't fit into these three, at this stage of your development as a trader, avoid them. When you grow, when you get advanced, you can take such risk. So what are these currency pairs? We're dealing with currency, so let's quickly major pairs. Euro USD, GBP USD, that is pound, Great Britain pound versus dollar. AUD USD, Australian dollar versus US dollar. USD CHF, USD versus Switzerland franc. USD Canadian dollar, USD Japanese yen, Euro versus GBP, Great Britain pounds, GBP versus Japanese yen, New Zealand dollar versus USD, Euro CHF, Euro versus Switzerland franc, and I think finally Great Britain pound versus Canadian dollar. This should be your focus when you are dealing with the core FX asset class. For now, when you are dealing with the FX asset class for now, this should be your major focus. Why? They are mostly traded pairs, which means the prices will be fair. When an asset is mostly traded, imagine that I go to a place where they sell phones or laptops, and the only person that is selling HP, Toshiba laptop is just one man. It's just one shop, one company, one store in that whole market. It's the only one that's selling Toshiba laptop in fact in the whole country. The rest of the shops are selling HP. There's every tendency that the guy who is selling Toshiba laptop will increase and decrease his price at will. And there's nothing you will do about it because there's no other place to get it. But for the HP, if the shop one does not agree to your price to buy a laptop, you move to shop 2 that has HP. If shop 2 does not agree to your laptop, to your price, you move to shop 3. So because they know that they have competitors, they have places where you can move to, they keep their prices fair. When a few number of people own a certain asset, that asset can never have a fair price. That is the problem I have with some pair. Some pair are pegged, and that's why you should run away from them as far as possible. Example, USD Nigerian Naira. Avoid trading that pair. That's why I told you, be safe. Keep your money in dollars. Full stop. It is a when the government comes in to interfere with the free flow of the market, free float of the market of an asset, stay away. Same problem I have with crude oil. Except you want to dig deep into the reason why the government or those small number of people are holding those assets or they are pegging it, and you have a privy into their meetings, you have a privy into whatever they are discussing. This is when you should deal with such assets. But for fairness, go to asset classes and assets that are hardly manipulated because they are widely available. Okay, hope you are getting somewhere. So by yourself, you can choose yourself. If they come tomorrow and say another current asset, volatility junkie or Fibonacci coin, you know how to select yourself. You don't have to come and send me message and say, Mr. Conrad, can I trade this? I already gave you the parameters to know what to trade. Is it clear, guys? You can do your findings. That's why I gave you the first assignment. Search for the most capitalized asset among all these asset classes. Some of you did it, some of you didn't do it. You see where it's coming out now. Another assignment I would like to give to you, go and check for the most traded currency, most traded assets. Check for the capitalization of that asset, the availability of that asset, the tradability of that asset, and the volatility. If it's too volatile, you are playing with fire. Euro JPY. Euro JPY too. Some it falls under this list. It falls there. I mean, these are just the top majors. Okay, I'm not saying you should not trade. There are some Euro JPY, there is Euro AUD, all those ones. They are also, they follow under, okay? But these ones are the top, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I think top 10. Yeah, this is like top 10. So the rest of them, they fall under. All right. Do you know how to choose what to trade now? You know how to select what you should deal with, whether in real life or on the market. You know how you should deal with it. So you don't need to ask anybody any question. Just go do your findings. 3 things. How available is this asset? How traded? How often traded is it? Does it have any influence of the government or some few people holding it? How stable is the price? Once any of them are compromised, keep your money. That's why I said Naira is a compromised currency. Naira is a compromised currency. So keep your money in a currency that is stable. Euro, pounds, dollars. If any government says you are not allowed to keep any currency outside of your local currency, well, I don't know solution to that. Maybe you start buying safe your house and keeping your money. Is that okay? These are the focus for you to trade. The rest of them, you can add them as you improve, as you grow. Some of you can start trading. I know some traders trade this currency, South African rand with dollar. Some have good results with that. I mean, if you are good with risk management and the rest, and you have advanced, you can deal with certain things. You can even deal with Bitcoin. You can deal with all those assets that are being held by 1 or 2 people. You can deal with them. Okay, but we're looking at the level where you're just starting. You don't want to deal with currencies that are actually compromised, that are you are just a peg. You are like a pawn. they can sway. They can. Do you know somebody said one day that he will make dollar versus naira go to a certain price, and he did it in Nigeria. I was just laughing. Yeah, forgotten the guy's name. The guy said it. He came to public space and said he was going to make dollar to be at a particular price, and the next day to be at another price, and he did it. Why? Because they have a small number of them controlling it, controlling the availability. We've dealt with quotes, how to read a quote, bid and ask. So bid and ask is simply a terminology used for buying price and selling price. Usually, let me explain this to you. So if you look at this market watch, all right, you have it on your phone, you have it on your laptop. The market watch will show you the symbol, the asset classes, all of them are there. So you can see bid and ask, bid and ask, bid and ask. Bid means at this time of the day, this is changing, at this second, at this moment, this is the selling price, the price the broker wants to sell AUD for you, to you. Whereas ask price is the price the broker wants to buy. Remember the story I told you yesterday that I went to change my money to another currency, and then a middle guy bought it at a price from another lady and sold it at a price from another lady. So that guy is acting like a broker, like this platform. A bureau de change, a changer and an exchange. They always have 2 prices per time. What those 2 prices represent is, one price means amount they will buy from anybody that wants to buy, wants to give them the currency, the asset. The other price represents amount they will sell to another person if that person wants the asset, because they have to make a little difference, which represents their own profit. They cannot buy dollar, for example, at 300, maybe versus another currency. Let's use naira, pardon me. You cannot buy dollar at 300 naira and sell it again at 300 naira. Then why are they in office? Why do they have an office? So they need to they buy dollar at 300 naira, they sell it at 301 or 305, so they can make the difference as profit. So that's why you have the bid and the ask price. So if you come into a broker's platform like this, you should see that bid and the ask price changing per second, telling you at this moment in time, this is the price the broker you will use, if the broker wants to sell this asset to you, the bid is the price the broker wants to buy from you. The ask is the price the broker wants to sell to you. So the bid and the ask simply means, write it down. It depends on where you are standing at. If you're standing at it as a trader, the bid represents the price you will sell an asset to a broker or to another person that wants to buy the asset from you. And then the ask represents the price you will buy the asset from someone else if you are interested in buying it at that same time. So every time you have the bid and the ask, okay, it's just a very small difference in price. And the difference is the profit of the broker, which is called spread. There's the difference between subtract bid minus ask minus bid will give you the profit of the broker or the middleman or the financial institution or the bank or whoever is connecting the buyers with the sellers. Spread is the profit of the broker. Okay, so I think that's the end of the terminology. So we have the bid and ask, currency codes, and all that. So these are just terminologies. Just write the meaning down. Then another terminology is what they call PEEP. PEEP. PEEP means 1% of 1% of price. I hope I've not confused you with that. And that's the way they taught us in school, in finance school. But I will break it down to you, okay? I'll break it down. It's just 1% of 1% of price. That's what PEEP means. PEEP means the slightest movement of price. The textbook we're explaining to you is at 1% of 1%. So that means I'll break it down, okay? But just let me quickly run through what a textbook will show you. So if Euro USD moves from 1.34510, for example, to 1.34520, look at the difference. 510, 520. You see the difference? That is 1 pip. So, but because of the decimal dot that is there, it's going to pose a lot of problem. It's going to pose a lot of problem for you trying to find this answer. But I'll give you the step by step. Are you ready? This is academic one. It's difficult to really. Those of you who can get it from here, fine. But I'm going to break you and I'm going to give you the step. The PEEP now. Steps. So right. Let me give you steps to calculating a PEEP. This is where you should not miss this class. What is the difference between volatility and momentum? Volatility talks about how prices move fast or slow. So if prices move so fast in a short period of time is the definition of volatility. How fast a price moves in a certain number of time is the definition of volatility. But momentum, so if price moves very fast in 1 minute, they say it's very volatile. Or maybe in a short period, it might not be 1 minute, it might be 1 day, but that means volatility. But momentum, in the sense of technical analysis, is not confined to time. Momentum usually is about intensity, is about power, is about volume. You understand what I'm saying? It's about popularity. So when the momentum is high, it means everybody is going that direction. Momentum is high. Everybody is going that direction. The power, the force is going to that direction. There's a heavy force. You cannot stop that force. And momentum usually stays longer because It's a head mentality. Just like saying the bullish momentum means the bulls are in the control of the market. Exactly. So it's about power, it's about control, and it's difficult to unseat them. But volatility is more about speed at a certain short period of time. I don't know if I am able to communicate that. They are not like opposite to what and opposite. They are not like opposites of each other. It's just a different way to explain. So volatility is a negative for you. Volatility as a trader, you run away from volatility, but you love momentum because volatility sometimes doesn't last. It's just spiking of price. Sometimes price can spike. Pew, 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 pew. So when price spike like that, pew, 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 that's volatility. But momentum can also be volume. Yeah, I mentioned it. Volume, head mentality, a control of some sort. So that one is long lasting. When you find the momentum in a certain direction, it can stay there for as it's not a spike, it's not a fluke in the market. No, it's a real directional where everybody is going, where you should go. Is a focus of the market. It's no mistake. But volatility can be a mistake. Market can just go phew now and they come back again. So it's like, what happened? Steps to calculating pips. Do not miss me here. Hey, this is the most important of your learning. The first most important of your learning today. Do not miss me here. All right? Pay attention. Do not miss me here. Steps to calculate pips. Get it now and get it forever. Steps to calculate pips. So, for example, let's take a particular currency, a particular asset, a particular currency pair. Let's say Euro USD. Euro USD currently is let's say it's 1.34250. I'm just saying. And then you want to find out how many pips is made when the price moves to 1.34251. How many? Sorry, 260 rather. 260. How many pips is made when price moves to from 1.34250 to 1.34260? So the first step is this. Remove the decimal points, the decimal dots. Remove the decimal dots. Remove the decimal dots. Remove the decimal dots. So you write it as 134,250 and price going to 134,260. First step is to remove the decimal. Why are we doing that? Because if we puncture the difference in the calculator will give us 0.0000 something, and then we'll get confused. We want to calculate it without the confusion a calculator will give us. So just write it again without putting the decimal dot inside. Step 2, use your calculator to do your math. Use your calculator. Now, whatever you want to do, you want to subtract, now use your calculator to find the difference. We're trying to find 134,520 minus. So this is what we're trying to do. 13426 minus the difference between these two. The price moves from the lower one to the upper one. So we're trying to find how many movements that is. So use your calculator for this. What do you get? What does it give us? It gives us 10, right? Second step. So I've gotten 10. Now, the final step, the 10 that you got is called what? Points. It's not called pip. It's called points. Or some books call it pipettes. Or some books call it ticks. Ticks. Whatever they call it, whatever a material or book calls it, is the same thing. It means this price has moved by 10 ticks. Pum, 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 pum. From 50, 1.3450, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60. So from 1.3450, 1.3250 to 1.34260 is 10 ticks or 10 points. 1.34250, 51, 52, 53, 54, 55, 56, 57, 58, 59, 50. Your calculator 60. So your calculator will do it for you. Okay. You just remove the decimal. If you type 1.3450 minus 1.234, calculator will give you 0.0000, and then the confusion will start from there. So just remove the decimal before you use your calculator. The two steps are clear. Remove the decimal, then use your calculator to find the difference. 10 points. So if I say, but we have not finished the work, we are going to find pips, not points. So the relationship between pips and points, step 3. Step 3, relationship between pips and points is that 10 points is equals to 1 pip. That's the relationship between pip and points. 10 points is equals to 1 pip. So convert your points to pip. So what you need to do is to further divide whatever you got as point by 10. You are trying to find the number of pips between a price level and another price level. Let's say price moves from a 1.34250. Then later you saw that price has moved to 1.34260, and you're now asking yourself, how many pips has price moved? That's what we're trying to calculate. So we got 10 points. Now we have to convert points to what? Pip. Using the relationship 10 points equals to 1 pip. So anything you find your answer as, divide it by 10 points. So now we have gotten 10. If you divide that 10 by 10, you are going to get 1. So our answer is 1 pip in this example. 3 steps. I'll go over the 3 steps again before we break. First, remove the decimal dot. So write the figures without decimal dots. Second, use your calculator to do your subtraction. The answer you found is called points. Third, convert the point to pips by dividing the answer of your point by 10. That gives you how many pips you have made. Let's do one more example. And then I can assume that I can give you a small test on that. So we bought, let's start using our language. We bought Euro USD at 1.44211. Price moved up a little while, and then we decided to sell it back at maybe our take profit at 1.44311. Question: how many pips did we make? We bought Euro USD or any asset class at a price of 1.44211. We set our take profit, or maybe we waited, price went up a little, and then we sold it everything out again at the price of 1.44311. Now, question is the pips. How many pips was that was generated by us? So use the 3 steps. You want to attempt it first? Okay, I'm getting some answers. 10 pips, 10 pips, 10 pips. Okay, let's solve it together for those who didn't get it. So how do you do that? Remove the decimal. Remove the decimal. When you remove the decimal, what do you have? You have 1.44211, 1.44311. 311. Subtract with your calculator. You want to find out the difference. This is going to give you 100 points. Convert 100 points to pip. Divide it by 10. 100 divided by 10 gives you what? 10 pips. So we have just made or earned 10 pips from that transaction. So how many pips? How many points? I want to see your points. How many points is movement is this, and how many pip movement is this? 0.70701 this morning, and by this evening it has moved to 0.70921. We're trying to find out how many pips it moved today, or how many points it moved today. So the first thing is to remove the decimal. When you remove the decimal, let me get a new sheet of paper. So when you remove the decimal, you get 0, 7, the bigger one on top, 07921, because we are subtracting. 07921. Your calculator will knock off this 0. Don't get scared of that. Just type it like that. 07071. Your calculator doesn't like to keep a 0 in front of number, so it's his own problem. You write it the way you want to write it in the calculator. 7071. Now subtract. This gives you 2. No, this is not going. This is 921. This is going to give you 8. 2 here. 20. This is 1. What am I doing, Seth? 210. Don't mind me. So it's going to give you 220. Yeah. If you're in doubt, just pick your calculator and type 921 minus 0701. It's going to give you 220. This is not an exam, so learn to use a calculator, okay? It's not a problem. Trading is an open exam. Nobody's asking you to close your book. Close your book. So what did you get here? Points. We've just found points or ticks, or what they call pipettes. Now we need to convert this point to pips, and you divide it by 10, because the relationship between point and pip is that 10 points will give you 1 pip. So you want to find 220 points, just divide by 10. So 220 divided by 10 will give us 22 pips. So this is the answer, and this is the point, 220 points. Good. So those of you who missed it, take the correction. Now, since all of you, 90% of you have gotten it, let's add more knowledge to what we have been learning. Let's improve it. We've talked about going long, setting stop loss, setting take profit. Let's put all of them together. So let's say I wish to go long. Remember when you're going long, you're going vertically upward. You want to enter a buy before the price actually moves up. You want to set your take profit at an upward price above your entry. This is your entry. Take profit above the entry. We dealt with this yesterday. You want to set your stop loss in case you are wrong below your entry. This is what we did yesterday as well. So I wish to go long. I wish to perform this operation on a particular asset of my choice. Maybe Euro USD, maybe gold, maybe S&P 500, whatever. So let's say that asset, let's say Euro USD. Let's begin to mention asset now. Let's say Euro USD, and the entry price, the current price that I want to get in is my entry price. That current price is equals to 1.43210. My entry price is 1.43210. Are you following me? I want to go long on this asset. I believe I'm speculating that it's going to rise. Price is going to rise afterwards. Just like we said, definition of going long. Now, I told myself, if my speculation is wrong, is right, I want to target a profit of 100 pips. A profit of 100. Let me make life easier for you. 100 points. a profit of 100 points. Although we work a lot in pips here, but let's start from small to hard. I want to target a profit of 500 points. That is what I'm speculating. They are all speculation. So I'm trying to say, I don't want to be too greedy and think that this thing is going to go up, 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 up. Let me just target 500 points, and I'm sure price is going to get approach there, and I'm going to close and in profit. That's what I want to set as my take profit target. 500 points away from my current entry price. Then I also say, but wait, what if I'm wrong with my speculation? And price after I've entered that transaction, I've bought that asset. Price now fails to go up. Price now start to even go down. I want to cut short my loss quickly. I don't want to lose more than 100 points in that transaction. This is what I want to do. They call this thing word problem in school, right? All of us did word problem. Word problem in trading. So please help me now. Because the platform does not understand point pips and all those kind of things. Platform want you to impute the price of your take profit. It's as platform does not know pip. If you tell platform 500 points, you say, what do you mean? You get what I'm saying? Let me show you the platform. So before you deal with it, let me show you the platform. Let me show you how we take trades on the platform. Let me show you how you record your take profit and stop loss on the platform, so you know what I'm asking you to do. So look at, I'm trying to buy euro. This is what asset is a GBP/USD. I click new order. Watch, see stop loss. Can you see stop loss here? See take profit here. If I click buy, look at buy. If I click buy now, it will enter a buy for me at the current price of this asset. Now, this stop loss and this take profit, I am the one that is required to impute the price that I want to exit as take profit. Price, not pip, not points. This thing does not know point here. If you type 500 points here, to be telling you see error. Okay, so it doesn't know 500 points. It wants you to type the price. What price will that your take profit be? So put the price there. If you say you are targeting 500 points, what price is that level? Do you get my question? That's what you put here. So 1 point, whatever, 2, 5, 10. That's what you put. Price level. That's what that form needs. It doesn't need you to come and type 500 points here. It doesn't know what 500 point is. We are trying to do a long position. All of you know what long position is. We dealt with it before yesterday and yesterday. And yesterday I added to that knowledge. I said, when you are taking a long position, your take profit will be above the entry price, buy entry price. Your stop loss will be below the buy entry price. And that's the first question I ask you today. Now, I'm adding PEEP knowledge to everything. We are summing everything we have learned together. You're saying, I want to take a long position on an asset called Euro USD. The current price of that asset is 1.43210. And because I'm speculating that price will go up, I'm buying now, and I want to target a profit level that is equivalent to 500 points from my buy entry. So I need to find out what price will that place be. What is it going to be? 1 point, what will it be? Then also for stop loss too, I need to set a price that is equivalent to 100 points away from my entry, so that I want to know the price of that place, of the take profit and the price of the stop loss, so I can put it in that when I'm trading. I can set it in the platform so that when I click the trade and I enter the transaction, it will go. Once it gets to that take profit, you don't need to be there. Automatically, the platform can help you close it in profit if you set that take profit there. That is the whole essence of understanding this. So if you place a trade and you set your take profit and stop loss in that trade, you don't need to be watching that trade. No, you don't need to watch the trade again. It will be there on the. You can even shut down your computer. After you have placed a trade, you have set take profit, you have set stop loss, you can shut down your computer. The trade has been sent. The instruction has been sent to your financial institution that this man, this woman wants to buy an asset at this price, and she wants to set a target profit of 500 points, and she has set a target loss stop loss of 100 points. So once price gets to those levels, the broker will close anyone that he hits first. If he hits take profit first, the broker will help you to close the trade in profit. If he hits stop loss instead first, the broker will help you to close the trade in loss. So it's just a way to automatically place your trade. If you put your calculator and say 1.43210 plus 500, calculator will give you 501.43. So you are wrong because you are adding two things that are not in the same basis point. Two things they are not in the same. In school they will say everything should be in the same unit. Two of them are not in the same unit. This one is 500 points. This one is price. Are they the same? They're not the same. So you need to convert price to something that looks like points before you can do this work. That's the first step. You need to convert price to points. How do you do that? So remove the decimal. Again, always remove decimal. Write out the price 1.4 without the decimal dot. Write down the price without the decimal. Now, when you do this, the price now has the same unit of measurement with points. So you can now do your work. Subtract add 500. If you add 500 now, use your calculator. Bring you out to calculator, right? 143,210 plus 500. This will give you 1,500,005. 143,710. This is what it will give you. And then if you do, because this one is under, you have to subtract. Because this one is above, you have to add. Okay, so you subtract to get the stop loss. You subtract the figure your stop loss point is 100 points, and that will give you 1 point. Use your calculator. 143,210 minus 100 to give you 143,110. Use calculator. You will see that this is what you will get. You have not finished the work because still your platform does not recognize this price. You have not finished the work. Your platform does not recognize this price. The platform does not recognize this price because you did something. You removed decimal dots from how price should look like. So you have to replace back the decimal where the decimal should be. So look at the price again. Look at this price again. The decimal is after the first digit or before the last 4 digits. You can start from back or you can start from anyone you like. You can count from here 1, 2, 3, 4, 5. 5 prices from the back or 1 from the front. So the dot's supposed to be here. Here. This is now complete. So I've now set a take profit target at 1.43710, which is equivalent to 500 points from my entry price, buy entry price. Stop loss is 100. We are looking for 100 points. Look at it. They ask us to get tag. We don't want to lose more than 100 points, so we subtract. Okay, let me draw this thing. In a long position, you buy at the current price. You set your take profit above, and to get that take profit, you have to do a plus on the entry price. And then you set your stop loss below, and to get your stop loss, you have to subtract from the entry price. This is long positioning. Write it down. Draw this diagram quickly. To perform a long position, a long transaction on an asset, you enter buy at the current price, just click entry buy, set your take profit, decide what target will be your take profit, how many pips, how many points. Then you have to plus, add to the entry price to get the price of that take profit. And then you have to find stop loss, you have to subtract your desired number of points you want as a loss from the entry, subtract it from the entry price to give you your stop loss the price of your stop loss that you must impute on your computer. Draw this diagram down. It will help you. This is what I did when I was learning. I had to use diagram, So anytime I look at my notes, I say, okay, I'm buying, I'm doing long position, so I have to buy. So take profit has to be above, so I have to add. Okay, I have to add. Then stop loss have to be below, so I have to subtract. Oh, okay. So trading is an open exam, okay? Nobody's asking you close your notes. Come and write the exam. Come and place trade. Close your note. Come and place trade. You open your textbook, your exercise book, your jotter as you are trading your thing. So it's an open book exam. Are we subtracting pips or points? You're subtracting points. You have to work in points. Everything have to be in points. If you want pip, you have to convert the pip to points first. I'll give you an exercise like that. You will convert if you're dealing with pips, you convert that pip first to points. You need to work in points. Everything has to be in point. You have to, all units have to be in the same basis. All items have to be in the same unit. Sorry. Just like we did in math in school now. They say you should put everything in the same unit. So if they're not in the same unit, you cannot add together. So if something is in a unit that is not the same with the other, you cannot do anything with them. You have to convert all of them to the same unit. So everything has to be in point. Price has to be stripped off the dots, the decimal dots, so that it can look like a point. Your take profit and stop loss target have to be removed, converted from pips to points so that they can be in point. When everything is in point, then you can do your subtraction, addition, and do everything. Then if you wish to convert back, that is your choice. Is that okay? So you work all times in points. I'll give you a task now that will be in pips. Then you first convert it to points before you can do anything at all with it. So diagram for short selling. So if you are doing a short selling, means you're speculating that price is going to go down. So you will sell first at the entry price, at the current price. This is the entry. You sell at the entry price, expecting price to go down. So downward will be your take profit. And to find this take profit, here you added, but here you're going to minus. Remember this, that's why I'm using diagram. Remember, some of you are going to fall into the victim of doing this. Don't feel bad. All of us make the mistake. We're trying to find take profit of a sell. We are adding instead of subtracting. Then stop loss of a sell, of a short sell is above. So stop loss is above. And to find the stop loss of a short sell, you have to add, not subtract. I know here we subtracted, but here we have to add. So I'll give you an example too of a short selling. We will sell an asset at a certain price. We'll have a take profit target, we'll have a stop loss target, and then we'll decide to calculate the prices for the take profit and the stop loss respectively. Then I'll also give you another task that will have pips, and you have to convert it to points before you solve it. Once you can do these three scenarios, we have covered pips. First scenario, everything is in points. Second scenario, your take profit target is in pips. You have to convert to points to solve. Third scenario, a short selling, you don't have a problem with it. Then maybe the first scenario, the last scenario can be, how do you find difference between two prices? That one was the first easier one. Is that one we did? Just convert them to, remove the decimal, subtract them together. So these are just the four kind of things. But I'll give you exercises. When you do those exercises, you will never have a problem solving anything. So let me write the exercises down. Have you drawn this diagram? I'll write 4 exercises that will cover 4 different scenarios you will face in the market dealing with take profit, pips, stop loss, and the rest of 4. Just write this 4. Try and solve this 4, and you can assume that you will never have a problem with stop loss and all that again. Number 1 question. So we have 4 scenarios. Okay. The first one is what we have done. Find the difference between 2 prices. So price moves from 1.21122 to 1.21342. This is the first one. The second scenario is that we have point. Okay. Second scenario is that we want to do a long position. We want to do a long position. Okay. Entry price 1.65410. Take profit target 500 points. Stop loss target 100 points. This one is in points, so easy does it. You are buying. Long position means you are buying, so you buy at the entry price. So solve this. The third scenario, let's do a short position of everything in point as well. We're doing a short sell, a short position with entry at 101.211. Our take profit target, see the same, 500 points. Our stop loss target, 100 points. We've not done this one. You can give it a shot. It's the same thing. I gave you the diagram. It's a sell. Take profit you minus to get your take profit. Everything is in points, so you don't have to do a conversion of pips to point. Subtract from entry to get your take profit. You add to entry to get your stop loss. The final scenario. So if you can do this one, then you have covered everything. So I'll give you in pips now. You have to do a conversion from pips to points first. Long position. Let's do long to make life easier. Long position. Our entry is at 0.91210. Our take profit is going to be in pips, not points, please. Take profit is going to be 70 pips. So you have to do a conversion yourself to points. Then our stop loss will be 30 pips. So I'll give you 10 minutes to solve this. So get your notes, write it clearly in your notes, because this your notes will be your own notes for life. So write it. If you make mistake, I'm going to do the correction. There's no rushing. So solve this 4. Then you have covered all types of problems that might come that you might encounter in trading when dealing with pips and point and stop loss and pips and take profit. So the first one says we should find price movements when we calculate the number of pips or points when price moves from 1 point. Let me write it out here. 1.21122 to 1.21342. So that would be 1.21122 to 1.21342. Remove the decimal. I told you to always remove the decimal dot. That's when your calculator will understand what you're doing. When you do, this one becomes 12134.2. Then this one becomes 12122. Find the difference. So this is going to give you 2 It's going to give you 2. It's going to give you 0. So this is 220 point movement of price. Convert it to pips by dividing by 10. This gives you 22 pips. So this is the first one. If you wrote 220 or 22 pips, you are right. Good one. Clap for yourself. The second one says that we should do a long position from an entry of 1.65410, and then we should target a take profit of 500 points and a stop loss of 100 points. So we don't need to do any conversion of pips here. We just go straight to solving it. So a long position is that you buy now, they give you the entry price already, and that is 1.65410. You are anticipating price will go up, and I gave you a diagram that you have to add to get the take profit, and you have to subtract to get the stop loss. So if you're going to add, what did you say you should do? 500 points. So they wanted 500 points. So you have to change this first to point levels. That means you remove the decimal dot, so it's going to be 16, because otherwise your calculator will not know what you're trying to do. 165410. Then you can now add 500 to it. Your calculator can understand now. Add 500 to 165410 to give you 00019. So 165910. This is what to give you, but you can't write it like this because you don't have decimal inside. So you put the decimal. Look at this one. Decimal was after the first digit, so you put it here too. This is the answer. This is your take profit. Then the stop loss, they say target 100 points. You want to target 100 points. 100 point stop loss. So before you can subtract, okay, so we have already removed the decimal, so you can subtract directly 100 from here. So you subtract 100 from 165410, should give you 165310. 165310. Yes, you can't leave it like this. You have to finish it up by putting the decimal where it should be. Decimal is after the first digit. Always check the structure of the price, where the decimal is in the real price. So some currency pairs the decimals will be in the third number. So this is the second one. If you got 1.65910 and 1.65310 as your stop loss, you are very correct. The third one, it says we should take a short position and entry at 101.211 and TP of 500 points and SL of 100 points. Take profit of 500 points, stop loss of 100 points. You see, we have another currency pair that gives us this kind of prices. So I try to give you all types of problems you can find on the chart. So when you see an asset that has that kind of structure, you are not going to be shaking like, I don't know how to calculate pips for this kind of currency pair. This is usually all those Japanese pairs, they have this kind of structure too. So however they write it, is the same approach. Whether they have three figures in front of the decimal dot and 3 figures after the decimal dot, or 4 figures in front of the decimal dot and 2 figures after the, you just remove the decimal and solve your answer. That's all you need to do. You don't have to really worry where they put the decimal or where they don't put the decimal in the price. So it's short position. In a short position, we enter entry of our sell. They said the price of entry is 101.211, and take profit of a short position has to be downwards. When we have to subtract to find that, and stop loss is upward, we have to add to find that. So how many pips points take profit? 500 point take profit. So first of all, if it's 500 points, 500 points, 500 points, you know that this price has decimal figure in it, decimal dot in it. So you change, you move decimal. So 101, 211. Then you're subtracting. Remember, in the case of a short sell, you are subtracting to find take profit. Always remember, don't forget, most of us make the mistake too at the beginning. So don't beat yourself to that. So what's this going to give us? 100, 100, 12 minus that's 7, 1, 1. This is what's going to give us. And then look at where the decimal is after 3 figures. So 1, 2, 3, the decimal should be here. This is your take profit. So if price goes to 100.711, you have just made for yourself a 500 points profit. Then the stop loss is a target of 100 points. So to target 100 points in a short sell, we need to add. To target 100 points, we need to add 100. So add 100 to the entry price. That's going to give us 101,311. So decimal, three figures in front of the decimal, 1, 2, 3. You put it here, and this is your stop loss. So if you set 101.311 as a stop loss, you will not lose more than 100 points if that trade goes against you. That is the whole idea. If you set that place, you will not lose more than 100 points. Now, the last one, which is a little bit tricky, but is not tricky, is we do a long position at an entry of 0.91210. TP is 70 pips. So you have to convert those pips to stop loss is 30 pips. Convert those pips to first to point. Convert those pips to point first. You're doing a long position. That means we are buying now at an entry of 0.91210. We are going up. Take profit will be up. We add to find it. Stop loss will be down. We subtract to find it. So how many points? 70 pips. So 70 pips is the deal now. You have to change it to point. That gives you 70 times 10. That is 700 points. Remember the difference between pips and point is that 10 pips, 10 points equals to 1 pip, or 1 pip equals to 10 points. 1 pip equals to 10 points, or 10 pips equals to 1 pip. That's the relationship between pips and points. Write it down. 10 points equals to 1 pip, or 1 pip equals to 10 points. So whatever you want to find, if you are converting points to pip, you divide the point by 10. But if you are converting pips to points, you multiply the pips by 10. Is that okay? So it's just maths. It's simple maths there. That's all we need to do, and then the rest is the way. And this one, they say is 30 pips. So multiply 30 pips by 10, it gives us 300 points. So 300 points. So convert, change this to 0.91210. Then add 700 to get your 700. Add 700. So this gives you a take profit of 0.91910. Put the decimal back after the first 0. Decimal is here. That is your take profit. So the only thing we did there was just to convert that pips to point. Then the subtract 300 for the stop loss. That gives us 0. 9 0 8 9 1 0. So this gives us 0.90910. So if you got that, then you've dealt with it. Now I want to make a quick note. If you observe, I've been narrowing down the assets I'm dealing with to currencies. I've been narrowing down to currencies and maybe to stocks. So there's a reason why I'm doing that, because this is just the basics, the foundation for you. I don't expect that at this stage you start trading gold, you start trading, crude oil and all the rest. If you can do number two, it's the same in number four. Trust me. The only difference is that you mentioned here as PEEP and here was point. That's the only difference. They are the same. Buy something, put the take profit above, surplus below. The only thing you have to do beforehand is to convert these PEEPs to points in this case. And the relationship is that one PEEP will give you 10 points, or 10 points will give you one PEEP, whichever one you want to remember. One PEEP will give you 10 points. So which means if I'm looking for two PEEPs, I'll multiply it by 10 to give me 20 points. If I'm looking for 70 PEEPs, I'll multiply it by 10. It will give me 70 points. Is that okay? So if I'm looking for 70 PEEPs, just multiply it by 10. It will give you 700 points. So one PEEP equals to 10 points. So anything you get in PEEPs, if you want to convert it to points, you multiply it by 10. Then 10 points equals to one PEEP. Anything you get in points, if you want to get it in PEEPs, you divide it by 10. So if I'm looking for 700 points and I wish to convert this to PEEPs, just divide this by 10, it gives me 70 PEEPs. That is the only thing we did for that fourth question. The rest is the same with the number two. When we started, I said we have how many asset classes did we mention? These are the asset classes: the currency, the shares, the index, the commodities, the energy, and the cryptocurrency. So if you see all my energy, I've been focusing it to the FX and the shares, because what I want you to be able to do after this course is to actually start to trade. I mean, after practice, of course. And what I'm thinking in my mind is, if you start trading shares, it's not bad. If you start trading index, it's not bad. If you go forward to trade currency, it's still not bad. Okay. In the order of difficulty, index is easier to start trading, followed by shares, then followed by currency. In the order of difficulty. But these three are if you see them, I'm consciously trying to limit you to these three at this stage. If you observe, calculating PEEPs, calculating all that, I'm just trying to limit you to those three. Not because I don't want you to trade commodities and energy and cryptocurrencies, but I just feel that the complications and the analysis around those ones a little bit more fundamental. And for you at this stage, I don't want to give you a task of going to be watching the fundamentals of cryptocurrencies, who is buying what, or what the OPEC are saying about the energy or crude oil, or what US is doing on gold. Just focus on these three assets: currencies, shares, and index, and you do just fine, whether as a beginner or as a professional trader. Is that okay? There's a whole lot in currency. You know how many currency pairs that there are? A whole lot. A whole lot of currency pairs. Apart from the majors that I mentioned to you, there are more other currency pairs. Shares, you know how many shares that there are? Index. So in order of difficulty, this is how I want you to approach your trading. After your practices, make sure you have done your practice very well before you jump into trading. Okay. And for those of you that will move to the FAP, then we can deal extensively with other asset classes and other strategies and other things and research and other things. But at this stage, this is the least difficult. Index, then followed by shares, that's the stocks, whether CFD or the raw, whichever the broker that find out from brokers, whichever one they have available, call it physical or raw, whichever one, and then finally currency. So this is the order that I want you to approach your trading, in the order of the currency. Is very popular, no doubt. A lot of you would love it because of the leverage. Index. Quick question on index. Again, what I asked you a question yesterday. I said, how can you trade an index, right? You said you can either buy CFD or ETFs, right? Hope I'm not confusing you now. CFD or what? ETFs. The ETFs are the raw version of the index. They are like certain assets that follow the index, that mimic whatever the index is doing. CFD is a constructed instrument. It's not raw, it's not physical, it's just trends of price. And also it emanates from the stock exchange. So don't get scared about that. So if you can find a broker, some of you in the UK, in Europe, you should not have any problem with trading raw whatever, physical shares, physical index. If you don't have a problem at all, it is at your environment there. Any part of Europe that you are in, UK, US, regulations allow you to easily find a broker. But those of you who are not in that region, especially those of you in Nigeria and Africa, you would have to do a quick search, a good search, to find out brokers who allow you to trade physical assets. But if there are no brokers who can allow you to trade physical assets, then you trade the CFD versions of all of them. Is that okay? You still get the same amount of money and profit. It's just that you you can't get the leverage. I mean, of course, CFD even gives you leverage. Rather, you can't get dividends and all those kind of things. It's not a disadvantage to trade CFDs. It's not a disadvantage. If that is what you have available to you by your broker, go ahead. It's not a disadvantage. The only thing I don't like about CFD of these things is the overnight charges, commission plus overnight charges as a swap. But they are not much. Trust me, they are very insignificant. They are very, very insignificant. So that's the only disadvantage that I see. But you get leverage, which is an advantage on you than the guy who is trading ETF or the physical stock. Then some of you will now trade currencies. A lot of you, currencies are available to everybody all over the world, and it has leverage, a lot of advantages. We all love to trade currencies because the price moves farther, faster, more, easier to analyze. Now, volume. So what is volume now? Volume is they call it lot size, and some call it notional value. Whatever it is they call it on the platform, it's the same thing. They call it lot, they call it value, they call it volume. It means the quantity you are trading or you wish to trade. It means the quantity you wish to trade. Quantity you wish to trade. It means the quantity you wish to trade. Volume means the quantity that you want to trade. Like if you go to MT4, let me show you MT4 now. Some of you who have MT4 already on your platform, you will see lots there. Is it volume they put on MT4 even or lot? New order. You see volume. The MT4 calls it volume. See, volume. Currency symbol, GPUSD, volume, stop loss, take profit, buy. So before you place it, buy or sell or do a position, you need to set your volume. You need to set your stop loss. You need to set your take profit before you click sell or buy. If you're trying to do a long position, you click buy. After you have set everything, it means you're trying to buy now to sell when price gets higher. That's a long position. If you want to do a short position, it means you're trying to sell now. And then you click sell. Volume. What is this volume? It's a quantity you are trying to trade. Sometimes they call it notional value, sometimes they call it lot size. One for currencies. Now let's start with currencies. All of them have different ways they measure their volumes, okay? Currencies. For currencies, let's say euro, I'm trading euro USD. You are buying the base. Any currency that is at the base is what you're buying. Is that okay? Just a reminder. So if I say I'm buying euro USD, essentially what I'm buying is euro. What the USD there serves as the money that I will use to go and buy that euro. I need some dollars with me to go and buy that asset. So the first currency on your pair is what you are trading, whether you are buying or you are selling that pair. If the same thing, if you are selling a pair, you are selling euro. All right, you're selling euro. Whether you are buying the pair or you are selling the pair, it is the asset that is on the first item of the pair. The first item on the pair is the asset you are trading. So volume is what we're talking about. If I say I'm buying one lot size volume, one lot size volume, or one lot size notional volume, what that means in technical words is that I'm buying 100,000 of my base currency. My base is euro. So I'm actually going to the market to buy 100,000 of whatever currency is on the left hand side. That's what one means there. So if you go to your MT4, if you go to this MT4, sorry, I'm going to show you the MT4 again. If you go to the MT4 and you put one here, new order, you put one here in under this volume, see you put one. What that one means, symbol, maybe Euro USD. Let's look for Euro USD here. So Euro USD, where are thou? Euro USD symbol, volume one. What that one means is that I'm interested in buying 100,000. If I click buy now, I've entered to buy 100,000 euros. You see, wow, bossa, I don't used to have 100,000 euros in my account. How am I able to buy 100,000? How did the broker allow me to place the trade of 100,000 euros? That's where the leverage comes in. I will explain to you. Okay, just follow me. When you put one here in this lot size on this volume, it means you are buying 100,000 of your base currency. Are you with me, guys? So in this case, your base currency is euro. So we are buying 100,000 euro. That's what it means. You're trading with 100,000 of your base currency. And there are smaller versions, there are bigger versions. So you can have 10 lot. The lot is minimum you can place on that lot is 0.01. 0.01 lots. This is the minimum. This is the minimum. There's no maximum. Depends on your capital actually. This is the minimum you can trade is 0.01 lots. And that minimum, it means 1,000. That minimum means 1,000 euros. 1,000 of the base. Whatever it is in the base actually, it mustn't be euro. I'll just use euro USD as an example. Anything that is in your base is what you are trading. So they call it 100,000 notional value or 100,000. You see some broker, some platform that you will trade with, they will want you to actually write the volume in this format. Yes, some platforms are like that. So don't be scared. So when you type 100,000 instead of one lot in the case of MT MetaTrader 4. So depend on the platform you're using, but we are teaching you MetaTrader 4 here. So you're not going to type 100,000 there, just put one there. So if you download another platform, the platform might require you it might tell you to put it in the theoretical way. Asset you are actually trading is your base currency. The second one is the transferable money, where either that's what money you will get when you sell it, or the money you will need to buy the base currency. Lots size and the theoretical, or they call it notional value. When you hear the word notional, sometimes it means theoretical, just theory. That's what it means. So 1 means 100,000 of the base. 10 means 1 million of the base, and so on and so forth. 0.1 lot size means 10,000 notional value. 0.01, which is the least lot size, means 1,000 notional value. That's the theoretical meaning. That's the real meaning. That's what it actually means. It means you actually. So, you see, without leverage, the minimum amount you need to trade in Forex will be 1,000 of your base currency. You need to actually go out. If you want to trade 100,000 euros, you need to go and find 100,000 euros and the value of equivalent of 100,000 euros and deposit with your broker. If you want to trade 100,000 euros, you need to find the equivalent version of 100,000 euros and trade. You see why currency is more interesting? Because the broker allows us to trade these quantities even without having this amount of money in our accounts. So, lot size and the theoretical meaning of it. Okay, the final thing I want to tell you is how much money. I'm going to use a typical example of Euro USD. Okay, I don't want to bore you with how the value is gotten. So this is the dollar value for every 1 point, every 1 point made, or every 1 point lost. Dollar value for every 1 point made or every 1 point lost. If you trade with one lot, if you bought or sold Euro USD, I'm using Euro USD now because the values differ according to the asset. You don't really need to bother yourself about what the values are. I just want you to understand the concept. Okay, I can provide you a sheet of paper that gives you all the values of all of them. So when you use one lot, when you place one lot on your trade and you execute that trade with one lot, every 1 point earned or lost by you in your favor or against you, every 1 point earned is $1 earned. Every 1 point lost by you is $1 lost. If you use a quantity of one lot size. Okay? Again, you do not need to cram this thing I'm telling you. I'm just teaching you for understanding purpose. Is that okay? I can provide you a template that shows you all the values of all these things. It's just theoretical. Just want you to know. Because we're calculating the other time, set 100 point stop loss, set 700 point stop loss, set 20 point stop loss. And somebody might be asking, if I set 700 point stop loss and I made that 700 points, price got to 700 points for me and I won that trade and I made 700 points. What does that mean in dollar value? What does that mean in dollar value? That's what I'm going for, that to explain what the dollar value means. That 700 points, it depends now on the lot size that you use to execute that trade. So if there are two of you, two of you made a trade and you all earned 700 points, 700 points each. It depends on the lot size you both used. If two of you use the same lot size, you make the same money. But if one of you use one lot, the other one use two lots, the guy that used two lots will make more, two times of what the guy that used one lot make, because the quantity he bought is two measurements. Just like you go to a market to buy crate of egg, and they say one crate of egg has 100,000 eggs inside of it. Let's just assume one crate of egg has 100,000 eggs inside of it, and you bought one crate of egg. So your lot size is one, but the quantity of eggs inside is 100,000 eggs. Whereas there's another guy who bought two crates of eggs. So what you will make, that guy will make two times of it, even though you make the same take profit point. So let's have lot size. Do your table like this: lot size, notional value or theoretical value, notional or theoretical value. What this means in theory. And then amount, that means dollar value for per pip, per point, dollar value for every point. So let's start with one lot. One lot means 100,000 notional, 100,000 of the base currency, which means you make $1 for every pip. For every point made or lost. You made if it's made profit, you lose if it's lost. 10 lots will be 1 million, which means you make $10 for 1 point. Then and so on and so forth. So let's go smaller. 0.1 lots means 10,000 notional value, which means you make $0.1 per point. That means 10 cents. 10 cents, $0.1 is 10 cents. While finally 0.01 lot, which is the least lot size you can ever use on the MT4 platform, means 1,000 of your base currency, and the profit or loss will be equal to 0.01. That means 1 cent. 1 cent. This one is 10 cents. Okay, so you have to note, if you use one lot, you are going to make $1 for 1 point that you make. If it's a loss, you are going to lose $1 for 1 point that you lost. Now, if you set a trade and you said take stop loss target 200 points, and the trade hits the price hits your stop loss, and you lose that trade, and the volume you use for that trade is one lot, note you are going to lose $1 for each of those 200 points. So you better reduce your lot size. So how do we know what lot size to use? If I have $100 in my account, if I have $1,000 in my account, if I have $10,000 in my account. But in the FAP, you will go extensive to understanding risk management. In the FAP, you would learn everything that has to do with risk management, from learning how to calculate, how to expect what type of amount of drawdown you have, because you have consecutive losses. from knowing what percentage percentage of your account balance you want to risk per trade and how to calculate that, and the advantage of that against just choosing any lot size from your head. But at this stage, you might just be advised to choose the least lot size. That might be the best advice. Finally, what about leverage? Let me test your knowledge quickly. Let's go back to the assignment with the classwork we just solved. Let's go back to one of them. 2 now. This number 2. Can you calculate for us? John and James are 2 traders. They are brothers. Let's use John and Veronica, because we have female traders here too. So John and Veronica. So John used 1 lot to place this number 2 trade. Veronica used 10 lots. Veronica used 10 lots to place the number 2 trade. So can you calculate if both of them made profit? Veronica 10 lots. John used 1 lot, Veronica used 10 lots. For number 2, this number 2. So calculate for them. You don't have to go further. Look at the points they made and point they lost. If they both make profit, how much will John make? And how much will Veronica make? Let's do that first. If John used 1 lot, Veronica used 10 lots. When they are setting their trade, that place I showed you on the MT4 where they used to write volume, John wrote 1 there, but Veronica wrote 10. But the both of them set the same trade, 500 points take profit, and that. Let's say this market went in their favor, both of them, their trade was, they won that trade. How much will John make in dollar? And how much will Veronica make in dollar? John $500, Veronica $5,000. Okay, John 500, Veronica 500, 5,000. Veronica 5,000. You see, you got the idea now. John makes $500, Veronica 5,000. Yeah, you see, but they made the same point. Oh, they got the same 500 points, but the money, in terms of money, they are not mates. But they all made the same. They went to the same school. They learned the same strategy. They placed the same trade. They got the same alert, the same signal. Buy, enter a long position at 1.651410. Set take profit 500 points. Set stop loss. They both got the same signal. But what differentiated their profit was that John used the volume of 1 lot, which means John will make $1 per point. And the same goes for loss too. So if they both lost, look at their loss now. They both set 100 points stop loss. Let's look at loss now. If they were not fortunate in that trade and they both lost, how much will John lose and how much will Veronica lose? I want you to do that again. If you're following me, John used 1 lot. He lost a trade that had 100 points. Veronica used 10 lots and he also lost a trade of 100 points. So how much dollar value? How much dollars has John lost and how much dollars has Veronica lost? Okay, John lost 100. Veronica lost 1,000. Correct. So if you are greedy and you use a higher lot size, though you will make more money, but if loss comes too, loss will be huge. If you are conservative and you use a smaller lot size, instead of using 1, you use 0.1 or 0.01, though profit is small, but loss too will be small. So it all depends on the level of risk you can take and also your account capital. If you know you don't have huge capital, do not go using high lot size. Hey, as I'm saying this, I just remember one thing that happened to us in 12 years ago in 2009, 2008, 2008, 2008, when we started trading in Nigeria. Some brokers, there were no training schools in Nigeria. Nobody training, like all this training that you are having like this, nobody had time to be training anybody. So the brokers will call you on phone and try to teach you how to trade. They just say, okay, go and buy now, go and sell this one. So this trade, I remember them, these brokers, they call them not finance. They are out of business now. Very crooked brokers. The minimum lot, look at how, look at the sense they came to Nigeria with. Of course, because they know that we don't use to research, we just jump into things. The minimum lot size you can take on their platform is 0.1 lot. Or was it even one lot? I think it was one lot. One lot. One lot. The minimum lot you can use in their platform was one lot that year, not finance. Criminal brokers. They set it to one lot. Minimum you can use was one lot. And then they now said that the minimum capital you can deposit is $100. You see how they finished also in Nigeria. They say we can deposit $100 and then we are allowed to use one lot. They now call us on the phone. Say, you can use one lot and we'll just put one lot like this on our $100. Market will just move 10 points. It is 10 points, 100 points, right? 100 points. And market can move 100 points in less than 5 minutes or 10 minutes. Market will just move 100 points. Our $100, maybe we are wrong, or our $100 has gone. We were never successful. We struggled. We didn't know. They will not allow us use lesser because they know that we don't have much capital now. When people are trying to start trading, they don't usually put large capital, they put small capital. So they did it so well. It's now I know that they are criminal. Before I didn't know, I thought maybe we were the one that had problem. No, they are the criminal. But now there's a lot of awareness in the trading world. So brokers allow you to trade 0.01 lot. Even now, some brokers have what they call cent account. Cent account, which means you don't even need $100 in your account. Even if you have $10, if you put that $10 in a cent account, it will amplify by 100 times. Cent and dollar is about multiply by 100. So you put a cent account, $10 cent account in $1 equals to 100 cents. So you have opportunity to learn with real money. So I don't want you to be ignorant of this lot size. I've taken my time. I don't want you to say, how did I lose $100? No. Because you use one lot. And when you use one lot, you lose or risk or make $1 per point. This point we are talking about, the market can move 100 points in 5 minutes or 10 minutes. I'm telling you the truth. This point we're talking about, I think it's when you say 100 points, it will take a whole day to get there. No, this point can move in 5 minutes, 100 points. Market has gone 100 points in 10 minutes. Start with the least lot size, 0.01, which means you will make $0.01 per point. And if there's a risk, if there's a loss, you will be losing $0.01 per point. That way, you are learning to understand, you are getting to understand what is happening on the platform. You will not be taken by surprise until you master it. When your profit grows, you can increase your lot size. So now leverage now and margin. They are like brothers and sisters. Leverage or margin. Leverage and margin. Let's say and margin. What is margin? What is leverage? So margin. Now, let me tell you something. I might, look at this table. 100,000 notional value one lot. I can trade this one lot even if I don't have 100,000 in my account. I've explained that to you before. All the broker needs you to have is what they call margin. And how does the broker calculate the margin? What does margin mean? Guys, so we have margin and leverage. Okay? So someone wants to trade one lot, and that means 100,000 units of the base currency. The broker will say you don't need to go and look for the 100,000 euros or equivalent to put in your account. Just put minimum of this amount. Okay? And it will give you the amount. So how you calculate that amount is called margin. Margin is the minimum amount the broker needs you to have in your account to use the lot size that you are using. Again, define it. Margin is the minimum amount the broker needs you to have in your account to allow you use the lot size that you are using. Margin, again, is the minimum amount the broker needs you to have in your account to use the lot size you are using. Broker doesn't need you to go and deposit 100,000 euros or equivalent in dollars or anything. No. You just need a certain amount of money, very small. How does it calculate it? Good. So at the beginning of your opening of your account, the broker will give you a range of value of leverage to choose from. Usually they give you, I think some brokers give you up to 100 or up to 500. Some of them will give you up to 500 to 1 leverage. Some of them will say 100 to 1. Choose any of them. Some of them will say 50 to 1. Some brokers give you up to 500 leverage. So let's assume you chose, when you are opening your account, you chose that the broker should allow you use 500 leverage. Okay, the leverage goes on and on and on and on and on until 10 leverage and until no leverage. No leverage is 1:1. This is no leverage. No leverage. That means you're telling the broker, I don't want your leverage. If I have 100,000 euros, I put it there, allow me to only trade 100,000 euros worth of assets, I'm fine. But if you want the broker to allow you trade more money than what you have in your account, you need to request at the beginning of your account. Chat with them and tell them the leverage they offer, and then you choose the highest. It doesn't mean that you are automatically taking risk. Just choose the highest. Some of them will give even up to 1,000 leverage. Some of them these days they give up to 1,000 leverage. Okay, some brokers give up to 1,000. What does that mean? So 1,000 leverage means that when you choose 1,000 leverage at the beginning of your account, you know what that means? That means the margin, the minimum money the broker will need you to have in your account to trade a one lot trade is this. Margin, therefore, this formula. Notional value of your lot size, whatever lot size you are using, the notional value of your lot size divided by your leverage. Follow me, guys. You open an account at the beginning of your trading. You told the broker, please, you offer leverage 1,000 to 1, right? He said, yes, please, I need that leverage. Now you want to trade one lot. Before you trade the one lot, you need to deposit money in that account. The minimum money you need to have in that account is called margin. The minimum money that is required to place that trade. Of course, you should have minimum of it in your account or more. The minimum money you need to have to place that trade is called margin. And the broker finds that figure by dividing the notional value of your lot size that you are using by the leverage he is providing for you. So in this case, you are using one lot. Notional value of one lot is 100,000 euros or whatever, divided by the leverage is giving you 1,000. So 100,000 divided by 1,000 means 100 euros. The broker will just tell you, Mr. Man, just deposit 100 euros in this your account and we are good to go. You can use that one lot. Just have a minimum of 100 euros in your account and you are good to go. But can I advise you? If you have just 100 euro in your account or equivalent, even though the broker gives you the opportunity to trade one lot, please take the leverage, but never ever trade one lot on that account. Remember my story, not finance, 2008. Never trade a one lot size, even though the broker will permit the trade to go. In a twinkle of an eye, if you are in a loss of 100 points, your whole capital will vanish. So the leverage the broker is giving to you is just for you to use it moderately. He has allowed you to use up to 1,000 leverage. In this case, why do you have to use one lot for this trade? So instead of using one lot, you can use something like 0.01 or 0.1, something lesser. Is that okay? So what I'm trying to sum up to you now is that margin equals to the notional value of your lot size divided by the leverage the broker is giving to you, which will give you the minimum amount that must be in your account, or it should be more than that. That's the minimum that you must have before you can place that lot size. Is that okay? So that is why it is possible for you to have just 100 euros in your account, or 100 equivalent of 100 euros in your account, and you're able to trade one lot size because the broker allowed you and gave you such a leverage. And 1,000 to 1 means is this. It means for every $1 you have, we allow you to access $100,000. For every one currency you have, will allow you to have access to 100,000 of that. That is what leverage means in a layman's word. So when the broker says, I'm giving you a leverage of 1,000 to 1, in a layman's word, what it means is that for every one deposit you do, you have an equivalent, theoretical equivalent, don't forget, to trade 1,000 of that thing that you deposited. You're going to be doing a research on them to know, how do I know if a strategy is going to be profitable? And that's not the end for you. You want to know, how do I do a back test? How do I do a simulation? How do I find out the success rate, the expectancy of a strategy? Rather than just take a strategy hook, line, and sinker because somebody taught me and use it, how do I define the truth myself? How do I know what strategy is going to be profitable? So it's a deeper, and the only way you can find out is having the skill to do research yourself. Because we want you to graduate from the FAP with about 4 major skills. Number one, the skill of technical analysis. We want you to look at a chart and be able to structure strategy by yourself. Our FAP students can design a strategy. You can give them a strategy now. They can change certain parameters from that strategy, and then they bring out a new strategy completely. So they are independent. That is the goal. That's my goal. Just to make you independent eventually. So whatever is going to go through that process. So first skill you're going to learn, you're going to come out with from the 10 weeks with me, is the skill of technical analysis. The second, which is dear to my heart, is research. Every trader who can research is a god. Is a god, small letter God. I'm telling you the truth. Every trader who can conduct independent research by himself is a small letter God. He can sit down like this now. He can think about an idea. He will know what concept to use to achieve that strategy. He can sit down now. You can tell him about an idea. He will put it together. He can research. He can do backtest. He can do simulation. That's the second. Then the third skill you will come out with from your FAP is market analysis. We want you to understand the market like your name. We want you to look at the chart and understand what is happening. Like you're looking at a picture. And you know, to do that, you need to have technical analysis skill and a whole lot, you know. And then the fourth skill we want you to come out with from the FAP is what they call risk management skills. Risk management means that no matter the storm, you can never ever fail again in this business, no matter the storm. So if you have been failing, if you have been crashing your account, if you have been losing consistently, risk management will end that for you. It's not prophecy. I'm not praying. It is pure knowledge, pure mathematics, pure practical and all. That with our training program, our FAP is going viral already. Our students are giving testimonials and all. But where we are heading is even bigger. And the team of people who would need to achieve those goals are our FAP students, our FAP graduates. We are not going to go outside to go apply, throw vacancy out to look for traders to manage funds. No, nothing. We have them in-house from our own guys. The guys who can do research. These guys are brains now. These guys are brains. So we have a vision. And I'm welcoming you to that vision. It's a big vision. If I could do it alone, I would have done it alone. I'll say, I don't need these guys. Leave them. Why am I teaching them? Go and manage your own. Then carry one of the investors, $10 million, manage. I'm not like that. If I wanted to manage funds alone, I would have abandoned anything training I would be doing in CEs. But that's not my heart. My heart is to see, because I didn't have this opportunity myself. I didn't have the opportunity I'm giving to you. I didn't have it. Every trader who wanted to tell me A would charge me money, and I don't even mind to pay. All right. So the FAP is not about the money. You have seen what we gave to you in the FFC. This one you have done. If we ask you to pay $500 for this one you did, we worth it. But we said so you can see our heart and let you know that we are serious people and we need serious members. So if you want to join us, let us take this thing together. And by God's grace, Forex Maestro is getting there. We need integrity. We need trust. We need seriousness. We need business-minded traders. Without that, we can't go anywhere. You will only be trading your $1,000 at best. You can't go anywhere. At best, you will only be trading your $10,000 at best. That's all you can do. So it's a big vision. It's a mind-blowing vision for me. So this is about FEP. And for those of you who will be there, I'm so happy to welcome you and take you through the journey.